So that means to move forward, we need to do two things. First, we need to calculate the market value of the debt, which means we need to estimate the value of all the interest-bearing debt the firm has, sum it all up. Second, we need to estimate the cost of debt. So we need to estimate the yield to maturity that the firm, or the yield to maturity on the existing debt that the firm has. That will give us an estimate of the current price the firm would have to pay to raise new debt. So what is the interest rate the firm would need to put on a new bond issue in order to get people to buy it? That's what the yield to maturity tells us. So we can look at this calculated example for UPS. Again, this is the same one we've been looking at the whole time. We can see that UPS had a cost of capital of 8%. That's their weighted average cost of capital. Of that, 15% of their capital structure comes from debt. 85% of their capital structure comes from equity. The cost of debt for UPS for debt is 4.9%, marginal tax rate of 37.1, gives us an after-tax cost of debt of 3.1%, which is pretty low when you think about it. 3% to raise corporate debt. This is because UPS is such a big and typically financially healthy firm. We see a pretty low cost of capital, cost of debt for them, and that basically arises because investors consider them to have very little risk, right? Remember that the risk-free rate in the U.S., the rate that we pay on risk-free bonds, which are sold by the U.S. government, is historically averages 2 to 3%. So this is not a very big premium relative to the risk-free asset. That means investors consider UPS debt to be pretty close to risk-free, even though admittedly it's not risk-free. And so we can talk more about what that risk characteristics look like and how we determine a risk premium as we move through the lecture. Okay. First step, we find the price. Second step, we estimate the cost of debt. And again, this is a pretty straightforward process. Bonds are public data, so public bonds are public data, so we can look at financial databases like Bloomberg or something called Trace, which is a bond price, a bond trade database. And what we're looking for is companies long dated, meaning they have about 10 years until maturity, option-free debt. And there's a couple of things here that's important. First one is we want to try to match the maturity, the remaining maturity of the bond, to the maturity of the cash flows that we're going to use to discount, that we're going to use the WACC to discount. So that means, remember, we forecast our free cash flows for 10 to 15 years. That means we're looking for a bond that has about 10 to 15 years of life on it. And that way we have a pretty good measure of the risk that investors are projecting for the firm, right? Remember, if I loan UPS money for 15 years, embedded into the interest rate that I charge them is the risk that they're going to be around for the next 15 years. All of the risks that might come into play for a company existing for the next 15 years. And so that is going to be a really good measure of risk that I can then use to discount the next, say, 15 years of cash flows. Okay? And then option-free, sort of outside the scope of this class to do a lot of discussion here, but what we want is just a plain Jane bond. We want a bond with no weird covenants, no weird rules on it. Options mean that the firm or the investor have some contractual option that they can engage if things don't go the way they want. So what we're worried about is, say, something like a callable option. This is a contractual option that the firm has to pay off the bond early, right? Now, because investors don't really want a firm to pay the bond off early, investors buy a bond to get a slow, steady stream of cash flows. They don't want to be paid off early. They're going to charge the firm a little bit more if they are going to give the firm the right to pay the bond off early. And that means that the interest rate on a callable bond with that callable option in it is going to be slightly higher than the true rate of return for the firm's debt. Other options are going to have similar things. There's options called potable options that are in bonds, and that means and these are pretty rare, but this means the investor can force the firm to pay back early. They can do what's called putting the bond to the firm. And that's a little, again, I mean, think about it like if you had a loan for a car and it had a potable option in it, that would mean the bank could call you and say, hey, tomorrow you got to pay your loan off. not something an investor or a borrower is going to want to do. And so if a borrower agrees to give that right to an investor, they're going to get a much lower interest rate in return for giving up that right. And so we want to avoid any of these weird idiosyncrasies with what different rights might give different interest rate, different bonds interest rate. Okay, so we're just looking for the simplest, long-dated, similar maturity bond. Okay, if the bonds don't trade, and this is more common than you might think, we are going to run into an issue where, because we don't have a correct current updated price, we won't be able to use the formulas we know to estimate the yield to maturity for that debt. Right? So the only way to get a current yield to maturity is to have a current price. Okay? Now, bonds aren't very liquid, and lots of bonds don't trade very often. And so if we don't have a current price, we won't be able to use our formulas. That means we're going to have to use a workaround. And the workaround is actually pretty straightforward. We take the risk-free rate as a benchmark, and then we try to estimate the riskiness of the firm relative to zero risk, the risk-free rate. How much more risky is UPS than no risk? If we can get a decent estimate of what that level is, we can compare it to other firms. We can use credit ratings. So there's companies out there that rate the riskiness of firms like that. So if we can find an estimate of that we're comfortable with, we can then just assign a premium, which is simply just saying, okay, we think this firm has a level of risk that justifies 3% more interest rate than the risk-free rate. That's a premium. So we can assign a premium to the firm based on its level of risk, and then that's our estimated yield to maturity. That's our estimated cost of debt, what the firm would currently have to pay. Right? And we can do this in a couple of ways. The easy way is if the firm has a credit rating. The harder way is we try to look at the firm's financial characteristics and we try to estimate the firm's risk on our own. And that's considerably harder. Okay? So these are the edge cases. For most firms, we're going to be able to use a formula for yield to maturity, and hopefully a formula that you've seen and used before. Okay? So here's the formula for the present value of a bond. Right? So for the most part, when we're talking about corporate debt, we're talking about bonds. Right? Companies have access to a lot of sources of different kinds of debt. They can take out traditional bank loans. They can take out longer term bank loans. They can take out shorter ones, which are called revolvers, which are often called revolving loans. So they have lots of different bank facilities that they can use. But those make up a relatively small fraction of the total amount of debt raised. And it's because banks just can't afford to give companies of the size of UPS a loan that they actually need. Right? UPS might want, say, $10, $15 billion worth of debt. But there isn't a bank in the world that can afford to make a $10 billion loan. They just don't. Even the biggest ones like Citibank, they can't have a loan of that size in their portfolio. It would dominate everything else. So what that means is companies turn to what we call distributed debt, which is essentially a bond. Okay? So a bond is a bunch of small loans distributed to lots of public investors. Now, bonds in the US are $1,000 in size, and a company might issue, say, $1,000 bonds, and that would mean they raised $1 million worth of debt. $1,000 times 1,000 bonds. Or they might raise $1 million bonds, issue $1 million bonds, and then they would have raised $1 billion. Right? So that is what makes up the majority of a firm's debt, and so that's where we'll sort of focus our cost of debt here. Okay? Because we can use the fact that bonds are publicly traded to help us estimate what the current cost of debt should be, even if the firm hasn't issued bonds in a long time. Okay? So a bond, on the face of it, just in pure financial terms, is an annuity with a future value. And what that means is an annuity, remember an annuity, is an investment that has level cash flows for a fixed period of time. So that means, just like any other loan, a bond is going to have fixed interest payments that are the same for a fixed length of time. Remember, a bond is a loan, so eventually the loan is paid off. And then the future value is a unique characteristic of a bond relative to like a standard consumer loan, which is that instead of making interest and principal payments together, like a standard consumer loan, your payment on your car loan has some principal and some interest in it. For a company's bond, we have what are called interest-only payments. And that means that the company only pays interest payments, and then at the very end of the loan, they make their last interest payment and all of the principal payment all at once. Okay? And that's the future value. So the annuity is the series of interest payments that are paid over time. The future value is that last balloon payment, which is the entirety of the loan amount. Okay, so the firm might pay interest for 10 years, and then boom, you get your $1,000 back. And remember, $1,000 is fixed. All bonds, not all, 98% of bonds issued in the US are for $1,000 face value. And you might buy 10 or 20 or 30 of those, but each individual bond itself is worth $1,000. You're loaning $1,000 at a time. You might choose to loan the company $2 million in total, but that would just be a series of $1,000 bonds. Okay? So the present value or the price of a bond is as follows. It's the present value of the stream of interest payments, which are called coupons, plus the present value of that final face value amount, the lump sum payment that you get at the very end of the bond's life. Right? That's called the face value. Add those together, that's the price of the bond, which is simply the present value of its future cash flows.